retail investors, mom and pop investors, they almost always underperform the market at large. And you can see this most clearly with stocks, right, Denny? I mean, how does your stock portfolio perform over the years compared to, say, the S&P 500?
We definitely underperform.
Yeah, and you're certainly not alone. I mean, that's the case for almost every retail investor. So there was a 20-year study done by Dalbar a few years back, and they looked at how retail investors' returns looked or performed between 1998 and 2017. And they found that retail investors earned an average annual return of 2.6%, which is like barely above inflation. Like inflation over that period was 2.1%. The S&P 500 over that period was 7.2%, which is a little less than the historical average, but still way higher than,
It's
I mean, that's almost three times higher than the average retail investor's performance. Now, real estate investing, passive real estate investors, they do tend to do better than the average stock investor, but they're still not performing at the level of institutional investors. So that's what we wanted to talk about today is how you as a mom and pop real estate investor can get those same kind of returns that institutional investors, who are out there investing hundreds of millions of dollars at a pop, where are they going? How are they doing it? How can you match their returns? So the gist of our episode today is just, how can you watch what they're doing and then mimic it to try to, earn similar returns. So we're going to talk about what is institutional capital doing right now? Where are these big institutional investors putting their money and how can you do the same thing? How can you follow suit?
and
So,
how can you watch what they're give me an example.
so high level, here are some of the trends that we're seeing among institutional investors because they tend to lead the market. They tend to be the first people to move in these directions. And then, gradually retail investors kind of follow suit. But if you can be an early adapter of that, an early follower, be ahead of that trend of the other retail investors and do what the institutional investors are doing, then you can get the same kind of returns that they're getting. So high level here. Here's just some macroeconomic stuff that is guiding some of these trends. So first of all, higher interest rates lasting longer, right? We have seen high interest rates for 3 years now, 3+ years. The
Yeah.
Federal Reserve started raising interest rates in early 2022, and they've stayed high since. Especially real estate interest rates, mortgage rates. Both on the residential side and on the commercial side. And even when the Federal Reserve has cut rates over the last year or so, mortgage rates have stayed high. They've stayed above 6%. So that's one macro level trend driving some of these other investing trends. We'll jump into the investing trends in just one moment. Um, Affordability crisis, still very much a thing in residential real estate, both on the rental side and the buying side.
Big time now because prices have gone up, interest rates have gone up, incomes
Yeah,
have gone down.
absolutely. And, home prices in the US are hovering around all time highs. So if you look at Zillow data, for example, they hit an all time high of earlier this year and have been hovering around there ever since. The all time high was around $366,000. This is, nationwide average, of course. And they're around $364,000 right now. So it ticked down very slightly, but we're still hovering around all time highs for average single family homes. Other sort of macro level trends driving some of the where institutional capital is going. They are looking for cash flow and income, and they're also looking for tax optimization and recession resilience because there's a lot of concern among institutional investors about lack of stability in the US, both from a regulatory standpoint and from an economic standpoint. Political instability does lead to economic instability, and there's a lot of concern among institutional investors about that. So, the word that's being thrown around in institutional investing circles is anti-fragile. They're looking for anti-fragile assets. So, things that are,
Anti-fragile investment.
it really means resilient assets that are going to cash flow well, even during economic downturns, even in the midst of, economic instability, political instability, regulatory instability. So,
Okay.
I kind of like that term, anti-fragile. Yeah, I mean, it is sort of corporate speak, but I don't know. I feel like it does kind of encapsulate this whole notion. All right, so where are institutional investors putting their money? First, in like critical infrastructure. So that's data centers, and they're looking at, where are the corridors of land where people are building out data centers.
Mm.
Those need rail supply and they need power transmission corridors, right? You need plenty of power running along those corridors. So
Wow.
here, yeah, so I was looking at this data right before we hopped on, Denny, and I thought this was a crazy stat. So Colliers, and we'll put a link to this in the show notes, and we'll also put a graphic on the screen for people watching a video. Um, so earlier this year, Colliers reported that data centers now account for 35% of all the global real estate fundraising in the first half of 2025. 35%, over a third, going
That's
towards data centers, and that's up from around 15% in 2020. Right? So, I mean, that's a huge jump in just 5 years. And, we all know what's behind that, of course, is AI. In 2020, we didn't have AI, and we just had servers and cloud computing and that sort of thing. AI chews up a lot of data crunching power. So, yeah, 35% of all publicly raised real estate funds in the world. That's nuts. So anyway, we'll link to that in the show notes and show a visual of that. All right, next trend: single family rentals and build to rent properties, because there is still a rental housing shortage in the US. Now, in some cities, they have seen an oversupply glut, particularly in the Sun Belt. We've seen a lot of, in some of the cities in Texas, for example. Danny, you and I have seen that in some of the investments we've looked at,
yes.
facing some oversupply. But in general, around the US, there is a deep shortage of rental supply, especially single family rental supply compared to the demand for it.
And
So
big
that
for it.
Yeah, and that's a great point actually about affordability. So institutional money is actually not going into luxury new construction for rentals. It's going into durable workforce housing in middle America primarily. Like kind of like the stuff that, so Denny, you and I have invested in the co-investing club. We've looked at a few multifamily properties in Cleveland that are workforce housing,
Right.
and they've been performing great. And those both of those investments have been paying an 8% distribution yield every year. But that's the kind of stuff that institutional capital is chasing, right? That's the kind of stuff they're going after. The sort of workforce housing, middle America, just meeting that affordable housing demand for everyday people.
Right.
So here's a stat on this regard. And this is from a little earlier this year, earlier in 2025, over 110,000 single family rentals under construction at that moment across the country. And that's a 53.5% spike in build to rent inventory for single family homes. So 53.5% spike. That's a huge jump.
Yes,
So
it is.
clearly, yeah, this is something that institutional money is suddenly going after with a vengeance, and you can understand why. I mean, there's a huge demand for it, especially in the context of what we were talking about a minute ago, about how home affordability is a real struggle on the price, on the sales side, the buying side. So more people are just renting longer, maybe becoming persistent renters, and not planning to buy at all. So but they still want that single family home kind of experience. So there's a lot of that single family rental construction going on right now, and it's mostly being fueled by institutional capital, the kind of thing that you and I, as retail investors, retail passive real estate investors, we want to get in on too, right? All right, and then the third and final category that we're going to talk about today that institutional investors are really digging into is alternative passive yield investments. So here are a couple examples of that. That's energy participation. So oil and gas in particular, and we actually just did this month actually in the co-investing club, where we bought a fractional interest. They call it a working interest in a portfolio of oil wells in Texas, and that's a pure cash flow investment, right? So we buy in as like partial owners, basically, of these wells, and then they pump for the next few decades, really. I mean, we're not going to be staying in that long, but they
Okay.
they pump out oil for decades, and we get our money back through the cash flow of it. So after a couple of years, the cash flow has recouped our initial investment, and then everything after that is gravy, or return on our initial investment. But this is sort of an ongoing cash flow investment, right? It's all about yield and income. Notes, private notes.
Mhm.
institutional money is also going after secured notes. So these are, secured loans against real property. Denny, you and I have invested in a handful of these in the co-investing club over the years. And by the way, if anyone's not familiar with it, the co-investing club is the investment club that Denny and I organize. It's a passive real estate investing club. We meet on Zoom every month, vet a new investment, and any members who want to go in on it can do so with a relatively small amount of money compared to what you'd need to be investing if you're going out there and investing by yourself in these. Um, but yeah,
Allows you to diversify and not be too affected by all this stuff.
yeah, exactly. Having smaller amounts across more investments around the
Right.
country. So notes, we've invested in a series of secured notes over the years, and they've all paid like clockwork. It's a fixed interest rate, so it's a fixed return, but it's secured by real property, so and at a relatively low LTV. So if the worst happened and the borrower, the operator defaults, we can come in and recoup our money by foreclosing on them, on whatever property it is that they put up for security, whether that is a residential property, a commercial property, whatever. So notes, that's another place, that's another example of these passive yield assets that institutional investors are putting money into. And the other is land. And this is something that, we've actually done quite a bit of investing in over the last couple of years in the co-investing club. Not directly. I mean, again, we are passive investors, not active investors in these. But that can be land flipping. It could be leasing rights for things like solar or wind. You know, in the co-investing club, we've invested in a. It was actually just last month. We invested in a fund run by a land flipping company, and they buy around 50 parcels a year, and they're typically buying parcels for between 25 and 250 grand a piece. They hold them for around 4.5 months on average. So it's a pretty quick turnover business cycle that they have. And that fund pays a
What difference
consistent
it makes.
16% yield. It every quarter pays out at a 16% distribution yield. It's a great income yield. So
And
anyway,
there's
Danny, go.
many different ways that you can invest. Like, there's one particular, investment we've all done where somebody buys a lot and they split it into 4 lots, and I just think that's very cool.
Yeah, yeah, and there's another land investor who we've invested in the co-investing club, where his strategy. So, and all these investors, these land investors, a lot of them have like these niche strategies, which can really overperform. So one of them, they go out, they buy a vacant lot, right, just a parcel of land. They will install a manufactured home on it, a perfectly nice home, and then they sell it retail to a residential home buyer as a first time home buyer. And they're selling these for literally half the local median home price in that county where they operate. So, there's always going to be demand for affordable housing like that, right?
Yes.
So, quick recap here: critical infrastructure, real estate investments, build to rent properties, both single family rentals and multifamily rentals, but, particularly workforce housing, middle America. And then alternative assets that are focused on high yield, high income yield that are steady, you know, like oil and gas, like secured notes, like land investments, flips or leasing rights for renewable energy. And they're doing this because they want the predictable income. They are choosing that over like speculating on appreciation, right? Uh, they also are worried about inflation. So these are investments that can hedge against inflation. They're also all tax efficient. Like that oil and gas investment that we made, which is unusual for us. We're not oil people. We're real estate people, but you know, we but we the working interest in the oil wells. You can you can take most of that and then deduct it against your W-2 income, your active income, which is crazy unusual. That is not the norm. Anyway, so with real estate investments, you can often get those huge depreciation deductions. We can only use that to offset your other passive income, not your W-2 income, your active income. Options here for you as passive investors. One, of course, you can join the co-investing club. We look at these together every month, sometimes two a month, but you can also look on your own. If you have 50 to 100 grand to invest by yourself, you can go look at syndications, real estate syndications. You can look at fractional land investment or these working interests in energy investments. You can look at notes or note fund. So, again, most of these require 50 to 100 grand if you're investing by yourself. In our co-investing club, we go in with 5 grand a piece or more if you want to invest more, but each person can invest 5 grand or more a piece in any of these that they like. So, again, it's an easier way to spread smaller amounts across more deals, more investments. But, if you have 50 to 100 grand a pop and you don't mind, plopping that in individual investments, these are the kinds of things that you can look at to mimic these institutional investors. Denny, anything else you want to add before we call it a day?
No, I think this is clearly indicative of how the world is, and that's why I like our club because I think it adds a mode of protection. Instead of putting a large chunk in one thing, it's kind of safer.
Yeah, eggs and baskets and all those things that our parents always told us. Well, guys, if you got a fresh perspective out of this episode, please share it, like and follow the show. And we also have a free course on passive real estate investing if you're not familiar with syndications and notes and funds and all these kinds of things that we're talking about. So check that out, sparkrental.com/free. It's quick, simple, 8 episodes. They're all like 5 to 10 minutes a piece. So super quick and easy and fun. And on that note, stay weird, unconventional investor. We'll catch you next time.